Real research protects you from playing guessing games. You're not just being contrarian, you're being smartly contrarian. This means when the market corrects itself and the stock rebounds, you can profit from the rise. Plus, you'll understand why it rebounded, giving you more confidence for future contrarian bets. Over time, this habit of thorough analysis helps you consistently spot hidden gems while avoiding companies that are truly doomed. Contrarian investors often know it takes time for the market to come around. However, there is a thin line between patience and stubbornness. Some people keep holding a losing stock forever because they insist the market just doesn't get it. In reality, new information might have emerged that undermines their original thesis, but they refuse to update their perspective. If you're stubborn, you might watch your portfolio bleed as you cling to a stock with deteriorating fundamentals. Perhaps a competitor introduced a superior product, or the company's management took a turn for the worse. Ignoring these signs because you're being patient can lead to huge opportunity costs. Money you could have placed in a better contrarian bet sits locked in a losing play. That frustration might eventually push you to abandon contrarian investing altogether. A practical fix is to set exit criteria before you even invest. Write down specific red flags. Example, if the company's quarterly revenue drops for 3 consecutive periods, or if a major customers ditch the brand. These are your deal breakers. If they happen, it's a signal to revisit and possibly exit your position. This way, you're patient enough to give the market time to realize the stock's worth, but not so stubborn that you ignore genuine trouble. Another tip, do a scheduled health check every quarter. Ask, has anything changed that conflicts with why I bought this stock? If your reasoning still holds, keep going. If the main pillars of your thesis are crumbling, it's time to reconsider. By distinguishing patience from stubbornness, you avoid riding a sinking ship to the bottom. You still give your contrarian picks time to prove themselves, but you also stay alert to real threats. This balanced approach can protect your capital from unnecessary losses and ensures you remain flexible enough to move on to new opportunities when your original idea no longer makes sense. Over time, this healthy balance can significantly boost your returns and reduce stress. Some contrarian investors believe they should ignore all market chatter. They think any popular opinion is worthless noise. But while hype or panic can be misleading, market sentiment offers clues about why a stock is unloved. If you tune out sentiment completely, you might miss important details that explain a stock's price movements. If you don't check sentiment, you could buy into a stock right before a major negative event. For instance, maybe people are selling because the company is about to lose a critical patent or its CEO is under investigation. Without scanning headlines, social media, or analyst discussions, you stay in the dark. You might interpret a falling share price as a mere overreaction when it's actually the market responding to real, serious problems. Also, sentiment can signal when the tide begins to turn. If you're not listening, you might miss the early signs of a recovery, like analysts shifting their ratings or respected investors slowly buying in. By ignoring those clues, you lose a chance to time your entry or add to your position at better prices. Trade market sentiment like a weather forecast, not a command. Use tools or platforms that aggregate investor opinions. See how trading volume changes and read short analyst notes. Ask yourself, is this negativity based on a short-term headline or a deep-rooted issue? For a creative twist, maintain a sentiment ledger. Jot down the main reasons behind the market's negative view for each stock. Then, on the opposite page, list factual data about the company's long-term potential. Compare the two. If you see more hype or fear than substance, that's a true contrarian signal. By blending awareness of sentiment with your own fundamental research, you develop a nuanced view. You don't get sucked in by the crowd, but you don't ignore valuable market signals either. This helps you avoid jumping in blindly and also allows you to catch wind of any positive shift before others fully notice. The result? Better timing, fewer nasty surprises, and a smoother path for your contrarian plays to shine.